Hello students, welcome to all of you Shiksha 360 CAP classes. In this session, we have to cover the ABFM chapter number 9 part 3. So in this session, the main content that is payback period. We have to be discussed in detail regarding the payback period. So let's start our discussion. Chapter number 9, capital investment decision, part number 3, that is related to the payback period. So now let's discuss in detail regarding all the points of the payback period here one by one. So in simple language, what is the meaning of here? Two words. First one, that is the payback period. Second one, that is the discounted payback period. Clear? So first of all, here we have to discuss regarding the payback period. Payback period. So please try to understand, like you have invested in any business, or you have started a business and you have invested in that business rupees 1 lakh. So what is payback period? Payback period, basically it is the time. What is payback period? Basically it is the time in which you will get your amount back. Clear? What is the payback period? Basically it is the time in which you will get your amount back. That is to be known as the payback period here. Clear? That is to be known as the payback period here. So let's understand what they are saying here. That is, simply speaking, payback period, what is that? Payback period, basically it is the period at the end of which the initial investment, it is entirely returned to the investor. Clear? So what is payback period? Basically payback period, it is the period at the end of which the entirely initial investment, it is entirely returned to the investor. Clear? Initial investment, like here, they have invested rupees 1 lakh, that entire will return to them. So return of investment, it is a net cash flow. Clear? Return on investment, it is a net cash flow for each of the years. So further, that when the cumulative cash flow, it is equal to the investment it is to be considered to be as the returned and no further. Like what they are trying to say here, let's try to understand with the help of one example here. Like you have started a business with the rupees 1000. So this is the initial investment. And every year, how much that is the cash flow that is. First year, second, third, fourth, fifth, sixth, seventh. Clear? So there are total to be 7 years here. So total 7 years, and the initial investment, basically how much we are doing, that is rupees 100. You will see that the cash outflow here of each year, it is to be same here. Clear? That is rupees 200. It is to be same here. So within how many years, basically we will get our cash back? Our initial investment back, that is first, second, third, fourth, fifth. Within 5 years, we get our return back. Clear? So basically we get our whatever we have invested, we will get back. Clear? That is the cumulative. Clear? That is cumulative, basically within how many years that it's to be here? 5 years. Clear? So when the cumulative cash flow, it is equal to the investment. Clear? So that is cumulative cash flow, basically up to 5 years, it will equal to the investment here. The investment, it is considered to be returned and no further. Okay. So hope you are able to understand here. So even that is here, we are going to calculate like first, second, third, fourth, fifth, clear, within 5 years. So what is the period? Clear? If they are given any question, so what is the formula for that? Clear? What is the formula for that to calculate the payback period? So payback period here, with the help of this question, we are able to understand payback period is equal to the initial investment This here they are mentioned. So payback period, what is that? Payback period, it is to the amount to be initially invested upon estimated net cash flow per year. Clear? Estimated annual net cash flow inflow per year. Clear? So what is the payback period? That is payback period here. It is annual investment, that sorry, initially invested, that is rupees 1000. And here net cash inflow, it is to be same every year. So basically we will use this formula. This formula, it is to be used only in that case where the net cash inflow basically every year it is to be the same. Clear? Only in that case this formula it is to be same. From here we will get that 5 years. Clear? So payback period here it is to be 5 years. Clear? So in this way you are able to calculate this one. We are also able to discuss one another question in which the payback period, sorry, the cash inflow, it is not to be same here. Okay. So further, it is to be remembered that both the positive or negative cash flows are to be added till the total net cash flow. Clear? Till the total net cash flow equals the amount of the initial investment. Clear? So whether the cash flow it is to be positive or negative, we have to be continuously added. Clear? So it is to remember that both the positive or negative cash flows are to be added till the total net cash flow equals the amount of the initial investment. In other words, we can say that it is the cumulative cash flow. Clear? In other words, basically we can say that it is the cumulative cash flow which has to be equal to the investment. Clear? It is the cumulative cash flow basically which has to be equal to the investment. So the formula basically in those cases, clear, the formula basically in those cases where the net cash flow, where the net cash flow every year it is to be the same. Clear? So the formula we have already discussed, that is where the net cash flow it is to be same every year, that is amount to be initially invested upon estimated annual net cash flow per year. Clear? So this is the formula for that where the cash flow it is to be similar at every year. So please tell fast now if anyone has any doubt, any query regarding this point. Hope it is clear to all of you regarding that. Now we have to, in now further we will discuss it, that is in those cases where the net cash inflow every year it is not the same. So we have to be add up to net cash inflows from the first year till the total it is equal to the amount initially invested. Now this is another case when the net cash inflow it is not same. Clear? So in those cases where the net cash inflow every year it is not the same, so we have to add up net cash inflows from the first year till the total is equal to the amount invested initially. Clear? Till the total is equal to the amount invested initially. So this may involve net cash inflow. Clear? So this may involve net cash inflow during a part of an year. Clear? So what this involves, basically this may involve net cash inflow during a part of an year, and that part it is calculated based on the assumption. Clear? And that part basically it is calculated based on the assumption that cash flow it is uniform during the year. So how we basically what they are telling here we are able to understand with the help of one example here. After that we will discuss that example also which they have mentioned in the booklet. So now let's try to understand here. I will write it here when case. Please try to understand here when the cash inflow is not same. Okay, so now let's try to understand with the help of one example here what they are saying that. So in an industry, the project cost it is to be, we have to calculate the payback period. So project cost in that it is to be rupees 6 lakh. And after that we have to calculate the cash inflows. So how we calculate first one, that is it is to be 1,20,000 first year, second year 1,40,000, Third year, it is to be 1,80,000. Fourth year, it is to be 2 lakh. Fifth year, it is to be 2,50,000. Okay, so this is the cash inflows here. So we have to calculate the payback period. So now here we are going to see that basically all the cash inflow, it is to be different here. So how we can calculate the payback period in this year? So first of all, we will write here year cash flows. So in that case, we have to calculate the cumulative. Clear? So in that case, what we have to do? We have to calculate the cumulative cash. Clear? So in this case, what we have to do? We have to calculate the cumulative cash flow. So in the first year, whatever the initial investment, clear? So that will be the cash flow, 6 lakh. So we have to calculate up to 6 lakh, clear? In which year? Basically, we are going to calculate the 6 lakh here. So how we can reach that? Clear? So in the first year, what is the cash inflow? That is to be 1,20,000. So we will reach here 1,20,000. How much we have to gain? That is 4,80,000 we have to gain now. Second year, 1,40,000. So 1,20,000 plus 1,40,000, it is to be 2,60,000. So if we subtract 1,40,000 from here, I think it comes out to be 3,40,000. Clear? So it comes out to be 3,40,000. Clear? So now we have to get more 3,40,000 up to this much point. Till now, only 2 years it is to be completed. So in the third year, how much that is the cash inflow? That is 1,80,000. So we add 1,80,000 further, that it is to be 4 lakh. 1,80,000. 3 lakh, 4 lakh. 4,40,000 it comes out to be. Okay, so here what we have left? 2,60,000 plus 1,80,000. 4,40,000. Clear? So what after subtracting 3,40,000 minus 1,80,000? It comes out to 1,60,000. Clear? So we will require more. 1,60,000 more. In the fourth case, how much that is to be 2 lakh. Clear? But we will require only 1,60,000 here. Clear? To get our initial investment, we will get only 1,60,000. 40,000 here, it is more here. Clear? 40,000 here, it is more. So please tell fast now. Up to this much point, you are able to understand that is our target. It is to be basically 1,60,000 in the fourth year. But in the fourth year, basically, how much basically we are getting here? That is be 2 lakh. Clear? So 40,000 we are getting more. Clear? 40,000 basically we are getting more in the fourth year. So in that, we know that basically between 3 to 4 years, clear, between third and fourth year, we will get our amount back. Clear? Basically, we will get our amount back, but we will not exactly know, clear, basically at what duration or at what time we will get our amount back. So we know that basically it is 3+ years. But how we can exactly calculate the payback period here? So how we can calculate exactly the payback period here? So 3 years it is to be completed. 1, 2, 3. In the fourth year, how much we will require? 1,60,000. So write it here. And out of the from total, which is that is 2 lakh. 4/5. It is to be basically 0.8. So 3 plus 0.8 years, we can say that 3.8 years we will require here to get our cash back. Clear? Whatever we have amount invested in that. So within how much duration we will get our amount back? That is it is to be 3.8 years here. So please tell fast now. It is clear to all of you regarding. Just we have to calculate the cumulative cash flow. Clear? Why we are going to calculate the cumulative cash flow? Because the amount invested here, the cash flow which we are getting here, it is not to be same in each case. Clear? The cash basically which we are getting here, it is not to be same here. That is the reason behind that. We have to calculate the cumulative cash flow. Clear? In case the cash flows, basically inflows, it is to be same here. Then in that case, just we have to be use the formula. Clear? In that case, we have to be use the formula, which we have covered in the previous slide. Now we have to move to the next point here, which they have mentioned at that point. I will show you here. This one. Now, fourth point here, that is in the case of the discounted payback period. Clear? So now this one is the DPP. One more new terms here, that is the discounted payback period. Clear? So what is the meaning? Clear? That is in they have given the cash flow. We have to calculate the present value. Clear? In that case, we have to be calculate the present value here. So instead of simply adding the cash flow as it is the discounted cash flow that is to be considered. Clear? As per the time duration, there is change in the value. Clear? There is a time value. Clear? There is a time value or change in the value of the money. Clear? With the passage of the time, in that case, that is to be included here. That is in the case of the discounted payback period. Clear? Discounted payback period. So in the case of the discounted payback period, instead of simply adding the cash flow, it is to be the discounted cash flow that is to be considered, which we have already calculated in the time value of money. So now let's try to understand that what they are trying to say here with in the case of the discounted payback period here. There is one slide. Yes. DPP. Just try to understand here. Discounted payback. So same example I will take here. One more example to understand the fact here. Like we have investment here. We have done that is of rupees 1 lakh. And discounting of 10%. So how we can calculate the discounting factor? That is 1 upon 1 plus 0.10 power n. Here n is equal to the number of years. So from that, we are going to calculate the present value. Clear? From that, we are going to calculate the present value. Like we have 0 year, that is 1 lakh. It is the present value in that year. First year, 30,000. Second year, 50,000. Third year, this is the cash flows, 40,000. Fourth year, 30,000. Fifth year, 20,000. Clear? So on this way, we have to calculate that. Just try to understand at any point. If you are facing any doubts, you can ask here. So cash, first of all, we have to write it here, year 0, 1, 2, 3, 4, 5. Cash flow. So in the 0 here, it is to be 1 lakh. Clear? So it is the starting of the project. After that, it is to be 30,000. In the next case, it is to be 20,000, 50,000. In the third case, it is to be 40,000. Fourth case, it is to be 30,000. Fifth case, it is to be 20,000 here. After that, we are moving towards another factor, that is the discounting factor. So here it is to be nil, that in this case, 1 upon 1.10. 1 upon 1.10. It comes out to basically 0.909. Clear? It is. So here what we are getting here, that is here we are getting here the present value. So 30 into 30,000. So what is the present value we are getting here? 27. In the round of, we are getting here basically in the round of 27270. Actually, basically we are getting a 27272, but here by rounding of that is 27270. Next one, that is in this case, what is the discounting factor? Basically 0.2. So 1 divided by 1.10 power 1 divided by 1.10 power 2 here. It is to be 0.826. So 0.826 multiplied by 50,000. We are getting here basically 41,300. Clear? So how much amount, that is the present value, that is 41,300. Only after that we are going to calculate the net present value to calculate the payback period. First of all, here we are utilizing the value of what is the meaning of the discounting factor here. Next one, in the third case, it is to 1.10 power 3. It is to 0.7513. So 0.751 into, it is to 40,000 here. 3,040 rupees. Clear? 3,040 rupees. Fourth one, it is to 1.1 power 4. Power 4 here. Just you have to use the calculator here. 0.683. So when we are multiplying 0.683 into 30,000 here. So 20,490 rupees we are getting here. In the fifth year, it is 2.5. Power 5. 0.620. You have to use the calculator in all these cases. Clear? No need to worry. 0.620 into 20,000. 12,400. Okay. 0.1, sorry. 1 divided by 1.10 power 5, sorry. 0.6209. Clear? 0.6209. We will consider it as 0.621. It is 12,420. Now we have to calculate the net cash present value. Clear? This is the present value. So just changing the name here, net present value here we have to calculate. So it is to be in the first year 20,000, 7,720, 27,270. In the next year, we have to add further 41,300 plus 27,270. It is to be 68,507. Plus we will add more, that is 30040. This will add 98610. So from here we are able to understand that total 3 years it will be completed. Now in the fourth year, how much we will require here? 1 lakh minus 98610. We will get only 1390 in the fourth year. Clear? 1390. Clear? So what is the fraction here? 3 plus 1390 upon 20490. That much years. So 1390 divided by 20490 plus 3. It comes out to basically here 3.06 years. Clear? 3.06 years. This will be come out to be here. So this is the reason of the discounted factor. Clear? Discounting factor. Clear? This is the role of the discounting factor to be here. Please ask fast now. All of you are now, I think, able to understand regarding all the three factors. First one, that one, the basically annual cash inflow, it is to be same. Clear? Every year it is to be same here. In the second case we have discussed, that is when the cash inflow, it is not to be same every year. So in that case we have to calculate the cumulative cash flow. In the third year, there is a role comes out of the discounting factor also. Okay, so now we have to try to solve the numericals, what they have mentioned in the book. Clear? Or what they have asked in the book. So now move towards that. So the first question presents here in front of all of you. Suppose a project cost rupees 20 lakh. So initial investment here, it is to be rupees 20 lakh. And yields an annual profit of rupees 3 lakh. Clear? How much profit they will get here? That is rupees 3 lakh. after depreciation at the rate of 10%. So profit here 3 lakh, depreciation 10%, and that is to be also straight line method. But before the tax, clear, this depreciation we have to, that is before the tax, and that is tax here, it is to be 50%. So first of all, that is what we have covered in the session 2. That is same thing we are going to calculate. First of all, we have to calculate the cash inflow. Clear? That is to be same here. Clear? So straight line method we are using here. So profit before tax here, it is to be 3 lakh. So we have to depreciation, that is 10%, but before the tax. But before tax at 50%. Clear? So they will charge a tax on this profit. Clear? So tax, that is 50%. That is 50% value goes in the tax here. 3 lakh profit, so 50%, that is 1,50,000. So 1,50,000 here, it is the tax. So profit after tax, that is what is the amount left, that is 50%, that is 1,50,000. So add, we have to add here, that is what is the depreciation. Clear? That will be cash inflow. Depreciation here, what is the 10%? 10% of what? That is of the initial investment. Clear? That is 10% of 2 lakh. Sorry, 10% of 20 lakh. That is to be 2 lakh here. So we have to add the depreciation, return of depreciation, return of, we have to add here 2 lakh, 1,50,000 plus 2 lakh. It is to be total in cash flow here, it is to be 3,50,000. Clear? Total in cash flow here, it is to be cash inflow here, it is to be 3,50,000. What we have covered in the previous, same thing they have asked to be here. So just we have to calculate the payback period. Clear? So payback period, what is that? It is the initial investment. Clear? That is to be 20 lakh. And annual cash inflow, that is to be 3,50,000. Clear? So 20 lakh divided by 3,50,000. It comes out to basically 5.714 years. Clear? Or 5.71 years. Clear? So this will be the answer. Clear? So while calculating the cash inflow, clear here what they're saying, that while calculating the cash inflow, depreciation, it is to be added back to the profit after tax, since it does not result in the cash outflow. Clear? Because that depreciation basically will not result in the cash outflow. So the cash generated from a project, therefore it is equal to the profit after tax plus the depreciation. Clear? Please remember that. Cash generated, clear, from a project, what is that? Basically it is equal to the profit, that is PAT, profit after tax plus depreciation. So on the way, that is payback period, we are going to calculate here. Please tell fast now. Anyone has any query, any doubt regarding this point? Hope all of you are able to understand just what we have discussed in the theory. Just try to understand that. After that, you will not face any doubt in any example. Whatever we have covered here. Clear? Even you will not face any doubt in any question if you are able to understand all these points to be properly here. Now I will give you some another questions for the practice purpose, which you have to go through that. Clear? Suppose here ABC Limited is analyzing a project requiring initial cash outflow. Clear? That is what is the initial investment here, that is rupees 2 lakh. So and is expected to generate the cash flow. Clear? So this is the case where annual cash flow, it is not to be same here. Clear? So not is to be same here, and we have to calculate the payback time period. So what is that? In the first year 80,000, so we will write it here 80,000. In the second year 60,000, we will write here, that is 1,40,000 net cash flow. This in the third year we like 60,000, that is to be 2 lakh. So basically in the third year we will get the complete amount. What is the initial investment? Clear? What is the initial investment? This is the net cumulative cash flow. Cumulative cash flow. So So what is the payback period here? Initial investment upon the cumulative cash flow. So it is to be here 3 years. So please tell fast any doubt, any query up to this much point. So it's the payback period shall be computed by using the cumulative cash flows. One first year 80,000, second year just we are adding that 1,40,000. Third year we have added more. So in the third year, cumulative cash flow is basically equal to the initial cash flow outlay. So hence the payback period it is to be 3 years here. Please tell fast now. Up to this much point, if anyone has any doubt, any query, any question. So in this session, we have to discuss up to this much point. So one more example it is left here, that is example number 4. So this example basically we will give you for the practice purpose. So you can go through this example and we will cover this example in the next session. What we have discussed, this one, PVF, that is discounting factor. Here they have given the discounting factor that is to be 15%. Just you have to calculate 1 upon 1 plus 0.15. For the first year, it is to be 1. For the second year, just you have to remember that 1 plus 1.15. 1 upon 1 plus 0.15. Power n, where n is equal to the number of year. Here n is to be 1. Here n is 2. N is 3. N is 4. On the basis of that, we have to calculate the present value. Next one, that is cumulative present value. So in this way, we have to solve this question. Okay. So this is the process of solving this question, and in the end, we have to calculate the payback period. Okay. So try to solve this question, and if you have any doubt, any query, you can ask. In the next session, we will try to start with the accounting rate of return. Very, very important. All these are the numerical based topics. In the next session, we will try to discuss this point along with the question and one example here. Okay, so if you have any doubt, any query, what we have discussed in this session, please ask fast. In the next session, we will start from the accounting rate of return and try to solve the example number 4. If you have any doubt, any query regarding that, you can ask here. So thanks to all of you for joining this discussion.